tonight's national trends update covering the updates for January. So appreciate you all joining us this evening. Very excited to go through a lot of the information that we have throughout the presentation. So I'm Nick Elder with Ironton Capital, joined here by founder of Ironton Capital and Your Castle, Lon Welsh. How you doing, Lon?
Fabulous. How are you? Thanks for joining us, guys.
Yeah, quick note from our attorney here. Obviously, this is the real estate trends. There's no offering of investment opportunity, but we want to make sure that we still provide a disclosure in this nature. At the beginning of the presentation, there may be some references to Ironton Capital funds, and so that's why this is here. So again, this is not an offering of investment opportunity. You might see some forward-looking statements. If at the end of the presentation you want to reach out and discuss what our current offerings are that are available at Ironton, please understand that any investment involves high risk, and to make sure that you're making a decision with all of those who are involved in your decision-making process. And that being said, Lon, I'm going to turn it over to you if you want to introduce yourself a little bit more here, and Richard and Brent.
Yeah, so I worked as a strategy consultant for 8 years, and then I've been in commercial real estate development and the landlord for a little over 20, and built a brokerage called Your Castle Real Estate from scratch. Ended up becoming the largest independent in Colorado with about 750 agents. So I sold that in 2021, right before the rates went up, and started Ironton right after that. And then I've got two of the guys on our investment committee who have got similar, really fantastic backgrounds. So let's get into it. Like I mentioned and Nick mentioned, if you have any questions as we go, feel free to drop those into the chat box, and we'll try to address them as we go. So one of the more important things that's driving our overall market is consumer sentiment. And you can see the University of Michigan study on consumer sentiment, which is the thing that's quoted as consumer confidence in the media all the time, is very, very low right now. And that's partially because people are worried they're going to lose their job because of AI, partially frustration about the tariffs driving up prices. A lot of people think there's going to be a recession next year, and collectively all these things are weighing on the confidence level of consumers. And people that don't feel confident don't tend to buy houses. If you ask, is it a good time to buy? You can see that it's at pretty close to record lows over the last decade or so. So I expect that this is going to burn off pretty soon, and we'll start seeing a recovery on that. And better consumer confidence will help to drive the real estate market to be a little bit more active. So in reality, should we be negative about all this? And the reality is that, inflation is just a little bit above the target of 2%, not by a lot. Unemployment is really spectacular at 4%. The number of layoffs is increasing a bit, and job growth is slowing down a little bit. But overall, we're still pretty close to an equilibrium. So this actually is not a bad economy, even though everyone seems to feel terrible about it. About 75% of Americans think we're going to have a recession next year. If you ask economists, only about 25% of economists think we're going to have a recession. I personally don't think we'll have a recession. I think we're going to have a good year in 26. The government's spending a lot of money, has a lot of policies to encourage a good economy at the expense of having more deficits. So that's one downside to it. So is it a good time to be investing? Well, if you're thinking about multifamily, it's great because the number of renters who can escape to become first-time buyers is somewhat limited right now. You can see quite a few renters are having a hard time staying current on their bills. There's an increasing number of them who are behind on their student loans, and it's difficult to save up a down payment when you can't make the electric bill each month. So this probably means structurally we're going to see a higher number of people remaining as tenants for longer. It'll increase the overall renter pool, and the first-time buyer pool we have already seen is a lot smaller than it would normally be. So as a consequence, the average age of a first-time buyer is now 40 years old, as opposed to being in the 30s just a decade or so ago. Really material shift. And I don't see that really changing a whole lot anytime soon. Is it still a good idea to buy real estate? The Federal Reserve does a study of the wealth of different types of households, and what they found in the most recent study is the average homeowner household has a net worth of almost $400,000 versus the average renter is about $10,000. And as an owner of a lot of rental properties, I sometimes get to visit and see my tenants in a view of their lifestyle, and they always have better TVs, better cars, better stereos than I have. So apparently all their net worth is tied up in that. I have a crummy TV, so I don't have much tied up there, I guess. The nice thing is most Americans still pick real estate as the best long-term investment. And I think that's probably a reflection of that last chart because homeowners generate a lot of wealth over time from that. Any questions there so far on consumer confidence?
No questions so far, but guys, feel free to throw them on in the chat. And again, we'll address them as we go.
All right, sounds good. So let's talk about the national trends a little bit. So we're seeing that the market has been a little locked up. And what I mean by that is that for the people who bought a house in, say, 2020 or 2021, they probably got a mortgage rate of around 3% as opposed to today it's around 6%. Or they may have bought a house before that and did a refinance in 2021, so they still have that 3% rate. Those people have got sort of a barrier. They might want to get a slightly bigger, nicer house. They might want to be in a slightly better school district. Maybe they just got a promotion. They're working on the opposite end of town. They'd like to be closer to work or closer to an ailing parent. These are all the traditional drivers of real estate transactions. But if it's elective and sort of a nice to have, and you have to give up your 3% rate for a 6% rate, your mortgage payment might go up quite a lot. The good news is that effect is burning off. I'm going to show you a slide on that in just a little bit. But the last couple of years, you can see the number of home sales per thousand has been lower than traditional, largely due to that lockup effect. So how much has sales activity been impacted? Well, I broke this into 3 clusters just sort of for ease of analysis. So I want you to look at the middle first. So I gave you the lines for 2015 and 2019. This is the number of home sales by month. And this is the long-term baseline normal market, pre-COVID. And then during COVID, the Fed flooded the market with lots of cash, pushed down the mortgage rates to about 3%, and we had a boom in transactions that took place. And that's the top of the chart. So 2020, 2021, you can see that we were selling at a pace of 6.5 million to 7 million homes a year instead of 5.5 million. So it was a huge stimulation effect. Starting at the second quarter of 2022, the mortgage rates went from about 3% to 6% in a very short period, and the market really slowed down a lot. That's at the bottom of the chart. So you can see 22, 23, 24, and 25. The number of sales was more like in the 4 million range. So like more than 1 million less than would be traditional. I think what you'll see in the upcoming years is that the gap between this low level of sales and the traditional level of sales is going to close a little bit. So we'll sell more houses in 26 than we did last year. We won't close the whole gap, but we'll start making some progress. So I want to talk about this locked-in effect. So if you take a look at the blue line, this shows you of all of the mortgages in America, what percentage of them are at different mortgage rates. And the blue line at the top shows you the people who've got these incredible rates between 3 and 4%. And you can see in 2021, it peaked. It was like 42% of people with a mortgage had a super duper low rate. And that's declined from 42% to 29%. The reason why it's declined is that some people have got to do a real estate transaction no matter what the rate gap is going to be. So if you're getting divorced, somebody dies and the heirs sell the house, you're getting relocated to a new town and you don't have a choice, you can't carry 2 mortgages. Those would all be great traditional examples of why people have to sell a house whether they want to or not. So the lock-in effect of sellers being reluctant to sell because they've got a super low mortgage rate is declining. And this chart really makes that clear. If you look at the black line, that's the people with a mortgage rate under 3%. You can see that's also declined at about the same pace. The flip side is when they get relocated from here to Houston, they buy a new house in Houston, they get a mortgage there. Now it's going to be at the prevailing rate of 6.5 instead of the 3% they had here in Denver. You can see that those mortgages have gone from 6 or 8% up to something like 24% of the market. So for someone who's got a mortgage at 6% right now, if they had to do a transaction, they'd buy a new house and their new mortgage would be 6%. So that lock-in effect would not apply to that particular person. So this is one of the reasons why I expect the velocity of home sales will start to improve because the handcuffs are getting a little bit less dramatic each year. Let's pause for a second. Any questions there?
Yeah, no questions.
Wow, you guys are easy. I love it. So the amount of inventory has been increasing. So the challenge is that as inventory increases, as the buyer traffic is lower, there's a little bit too many listings, not quite enough buyers. The buyers have a shift in power. The buyers are more powerful in the negotiation process. Not equally true across all parts of the U.S., but definitely true on an overall basis. So that wouldn't surprise you that marketing times are increasing and the rate of price increases has slowed down quite a bit. I didn't show it here, but the number of homes being sold to first-time buyers is declining, as we talked about, and the number of homes being sold to investors is a little bit less than it had been in the past. So let's talk a little bit about where in the country we're seeing appreciation versus not. So blue is where we've had the most appreciation. So from the buyer point of view, that'd be bad. Green is where we've had the least amount of appreciation. So from the buyer's point of view, that's a good thing. So you can see in the last year, New York was up 7%, Wisconsin up 6%, Illinois up 7%, and most of the northeastern states did pretty well. North Dakota also very good, 6%. On the other hand, places not doing so well, Florida off 2%, Colorado off 1%, California off 1%, Texas about unchanged. So generally speaking, if you're in the Midwest or the Northeast, you're still seeing a modest amount of price appreciation. And the reason for that is that inventories have not grown very much, and the buyers have to work harder to compete to get a house. On the other hand, in the Southwest and the Southeast, there's been a huge increase in inventory. The sellers have got to be very accommodating to get a deal done, and the buyers have more negotiation power. So it's likely that this trend will continue for the next year.
Well, we got a question here. Given the buyer's market you describe and slowing of home price appreciation slowing, do you see a home price decline coming?
As a composite, I think prices will be roughly flat in 26. However, I think that's going to vary by market. If you're in Florida, you may see a small amount of erosion. If you're in New York State, I think you're going to see appreciation for the reasons we just talked about. Also, there's a gap between condos and houses. The entry-level condos are traditionally the domain of first-time buyers and investors. And the challenge for the first-time buyers we've talked about, so there's not a lot of demand in that segment. For investors, the rents have gone up a lot over the last 5 years, but not as much as the home prices or condo prices have just skyrocketed. So between the fact that prices are growing faster than rent, inflation for taxes and insurance has been off the chart, which has really driven up the HOA fees. And of course, the mortgage rates are higher now than they were 3 or 4 years ago. All these factors have conspired that it's more difficult for an investor to justify the purchase of a condo, a small one, as a rental, as opposed to, say, 2021. So I expect for those reasons, the low end of the condo market may see price erosion in many markets in the U.S. The high end of the condo market will probably be relatively insulated. So that's a long answer to a short question, but it's one that kind of, I think, deserves some nuance to the answer. Great question. All right. The number of price reductions is increasing. No particular surprise there. So I am frequently asked by you, what is this downturn like compared to prior downturns, and when will this downturn be over? So I want to share some history with you to give some context to that. So if we take a look over the last 60 years of the real estate market, there's been 4 downturns. Let's talk about their characteristics and what's similar to or different from the downturn that we're in right now, and see what kind of lessons we can extract from that. So in the early 1980s, we had very high interest rates, very high unemployment, and as a result, the Federal Reserve had to tighten up the money supply, and the mortgage rates were also very high. They were almost 17% at one point. It's very hard to sell a house with a 17% mortgage rate. So we'll talk about that. The next is the great financial crisis in 2008. So Congress directed Fannie Mae and Freddie Mac, the 2 behemoths that guarantee a lot of mortgages, in 1999 said, loosen up your standards, make it easier for first-time buyers to get a mortgage. So they loosened them up way too much. And for a period of time, we had something called a stated income, stated asset mortgage, where you could go into a loan officer, say, I make $200,000 a year, no pay stubs, no tax returns, no anything. And the loan officer said, yeah, you're approved. Here's an $800,000 loan, 0% down. Go buy something big. And they would, and they weren't financially qualified to do it. So that was between 1999 and 2007. Eventually, we led to a whole lot of people having houses they could not afford, and they all got returned to the bank as foreclosures. That is why we had a huge foreclosure problem between 2007 and 2010. Those loans are illegal now. So it's unlikely that we'll see a repeat of that kind of a crash due to that sort of mortgage misbehavior. The third downturn was in the first phase of COVID. So you might remember in March of 2020, we were at the apex of fear for COVID, and we were all under house arrest for a couple weeks or up to a couple months. And we weren't even allowed to leave our houses, let alone go show a property. Really hard to put a house under contract if you can't show it. And then we've got this most current slowdown, which is a result of the rates having gone from 3% to 6% virtually overnight. So let's look at some characteristics. I'd like to look at the middle column where it talks about the home sales unit count drop. So in the early 80s, with mortgage rates in the high teens, there was a 50% drop between the prior high record mark and where we bottomed out at. With the 2008 crisis, with all the foreclosures, the drop in the number of sales was 51% from high to low. During COVID, that was a relatively short period, but we saw a 27% drop like very, very quickly. This current correction we're going through, we've seen a 39% reduction in the number of homes being sold compared to the peak of 2021. So how long did it take for these prior recessions in the real estate market to recover? Well, with the super high interest rates in the 80s, it took 4 years. With the 2008 foreclosure crisis, it took 3 years. With the COVID, it only took 8 months. And the reason why is the Fed drove mortgage rates from 6% to 3%, and there was a boom that was ignited overnight. So it's a very short correction period. This time around, we won't recover at all. The reason why is the high water mark in 2021 of almost 7 million homes was artificially stimulated by these ultra low interest rates that we will probably never have again, at least in my lifetime. Without that kind of stimulus, we can't get back to a 7 million run rate. What we can do is get from like the 4 million that we sold last year to the pre-COVID average of like 5.5 million. That to me would be a normal recovery, and that should really be the appropriate benchmark. How long will that take? I think the answer will be probably 5 years. And we're more than halfway through all that. A lot of chatter there. Any questions on that?
No questions on that. I'm guessing too, a lot of the home sales drop, I'm guessing a lot of this is driven from, lack of activity from the buying standpoint, because we haven't built much, right? I mean, I look at things from a multifamily standpoint a lot of times, and construction starts are way down, which I believe is in parallel, probably very similar on the residential side. Yeah. So I'm guessing a lot of the home sales drop have been primarily driven by obviously interest rates that have gone up significantly. And then also just activity has probably been cut in half, if not more than that. You got houses just sitting on the market for, 3, 4, 5, 6 months and not 2, maybe right. I'm guessing that's primarily the driver of the home sales drop there.
Yeah, I think that's it.
Yeah. And then with double the interest rate, why haven't prices dropped more?
Well, what we saw in the 1980s is that the mortgage rates went from something around 8 or 9% to 17%. So the mortgage rates went up by 8% points, as opposed to this time went up by 3% points. And in the early 80s, the prices dropped like 2 or 3%. So a huge shock in the increase in interest rates doesn't tend to cause price declines. It tends to cut the number of deals that get done. It's very interesting behavior how that works out. As opposed to if you're selling some sort of elective commodity like chocolate, and I think chocolate prices have gone up a lot. I imagine that there's less chocolate getting sold now that the prices have gone up so much. Great question. Okay, will prices drop? Why? That's leading the witness there. Great question. We have seen that price cuts are bigger in the slower market. So this just shows you the number of days that the property has been on the market and a typical amount of reduction in price required from the initial asking price. If you can list your property in a more realistic price, it's going to sell a lot faster. That's always true. It's even more true in a market like this. I think one of the lids of why prices are not going to go up very much over the next 5 years is that relative to incomes, homes are pretty expensive. And if prices kept going up, just the potential pool of buyers who could afford to buy would get smaller and smaller and smaller. What needs to happen is we need to have a couple of years where the wage growth is bigger than the inflation rate so that people net have more cash available. And historically speaking, people will spend just about as much as they possibly can on housing. And that would enable prices to go up a little faster. Something that's not often discussed enough in the media that's an affordability headwind for everybody, and especially first-time buyers, is that taxes and insurance went up 45% on average in the last 6 years. Absolutely insane amount of increase in a short period of time.
Lon, on the insurance side of things, have you seen that flatten out a little bit? I remember 2022, I think to 2024. I mean, insurance, especially like on commercial, just skyrocketed. Have you noticed that flatten out throughout 2025? Where do you see that trend?
Yeah, it's definitely slowing down, at least in Colorado.
Okay.
I don't know if that's true in every state, but here at least, like they had several years that were really huge. They'll probably flatten out. We might see like a tiny decline. They'll probably be flat and then start going up again. So I think we're past the worst on all that. Fortunately, great question. So this measurement is taking a look at the value of all homes, not just the ones that sold, but the homes that weren't sold as well. And about half of the largest metro in the U.S., 50, had a very slight decline over the last year. Denver is off about 3%. And you can see a lot of the ones that had gains are very core Northeast and Midwest sort of cities. And the ones that declines were, Florida, Texas, and the Southeast. Nothing catastrophic, though. All right. So the overall forecast for 2026 is that prices will go up by 1.6%. So here's about a dozen economists that closely track the real estate market. NAR is a National Association of Realtors, that's on the left. MBA is on the right. That's the Mortgage Banker Association, the collection of all the loan officers that help us out with our loans. And you can see the average is about 1.6% is the expected increase. I think that's actually pretty close. We'll probably be right around that range for the country. So for sales volume, we came in around 4.2 million sold in 2025. The historical average for us should be closer to 5.5 million. The forecast from the economists is that we'll be at like 4.5 million. So we'll make up a decent amount of that gap this year. And I think that number is probably just about right. I don't think every market will be up, but I think across the average of the whole U.S., we're going to probably do pretty well. So will there be a price decline? And the answer is no. And the reason for that is that there's a huge amount of equity out there. So the reason why we saw big price declines in 2008 during that big foreclosure crisis was that on average, the typical home in America was worth less than the mortgage. So if you had to sell, you'd have to bring cash to closing. Most people weren't in a position to do that. So they just gave the home back to the bank. The bank absorbed the loss in exchange for the consumer getting their credit wrecked. This time around, if you look at the green line on the right-hand side, you can see there's just an enormous amount of home equity. And no one's going to give up their house if they don't have to, when they could walk away with a couple $100,000. So I don't think we'll have a recession in 26. Most economists don't, but consumers do. So a common question that we get asked is, what tends to happen to home prices during a recession? So we've had 6 years of recession over the last 40 years. And here's what's happened. You can see 4 times out of 6, the home prices went up during a recession. Not by a lot, just a bit. 1991, it went down a little bit, 2%. The only real exception to that is 2008, when prices dropped 20% in the U.S. And that's because it was the foreclosure crisis in homes that caused that recession. So that's the one strong outlier. What tends to happen to mortgage rates during a recession is they always drop. Now, if you remember 1980, the mortgage rates were in the very high teens. So if they dropped from 17% down to like 8%, it was like an 8 or 9% decline in mortgage rates. And that's what you see happen here in 80 and 81. There's a gigantic decrease in mortgage rates because there was a lot of room for them to fall. As opposed to in 2020, the mortgage rates dropped, but not a lot. I would anticipate during our next recession, probably in 2027, we'll see a very modest decline in mortgages, but it won't be a lot, like a quarter point, half point, something like that.
Lon, what do you think might be the driver of the next recession? Right, you mentioned 2008. Obviously, global housing crisis caused that recession. But what do you think might be the driver of the next one?
If we see unemployment decide to tick up quite a bit, because if consumer confidence is negative, people don't want to buy things, then our
Yeah.
factories don't need to produce much, which means some people might get laid off. I could see
Mhm.
that cycle kind of self-perpetuating. That's probably the
Yeah,
most likely cause.
makes sense.
Okay, will there be a foreclosure boom? The answer is no. If you take a look at how many homes are in the foreclosure process, it's 0.1%. So basically, like 1 out of every 700 homes is in the foreclosure process right now. Illinois and Florida are the leaders, and I think South Dakota is like the least. But overall, there's just not very many. You may see headlines saying the number of homes under foreclosure is up a lot. That's true. It was not allowed to do a foreclosure during the early and late stages of COVID 2021-22. Biden passed legislation that you can't foreclose on a house. So once that temporary legislation burned off, you're going from a rate of 0 foreclosures to, like, if you had even a small number, it was a gigantic percentage increase. And that's what the headlines you see are based on. If you see like there's a 40% increase in foreclosures year over year, it's off one very tiny number to another very tiny number. Mark Twain said there's lies, damn lies, in statistics, and that's a good example of that. I have a separate chart. It's not in this deck, just showing how many people are seriously delinquent on their mortgage, that is 90 days late or more, and it's very close to a record low. Overall, people are doing a good job. Here's another way to visualize the equity. If you take a look on the left-hand side, the yellow line shows there's $32 trillion of equity in all the homes in America, matched up against 13 trillion of debt. So it's a huge amount of equity. Now, if you rewind on that chart on the left to 2010, you can see on average, the mortgages in America were a higher balance than the value of the homes. And that's why we had so many foreclosures in 2009, 10, and 11. So the situation today really couldn't be any different from 2008. So I don't anticipate any significant foreclosure activity for quite a while. Interestingly, 40% of the homes in America don't even have a mortgage. So for those people, if they need to move, it doesn't matter what the interest rate is. They're just going to pay cash for their next house anyway. That's a really underappreciated fact that drives the market in quite a few different ways. So at a national level, foreclosures will be a non-event. Is it possible on a local level, there could be some communities that could have a little bit of an uptick in foreclosures? And the answer, of course, is yes. So this chart shows you where you have negative equity. So while the overall market, there's almost no homes with negative equity, there are just a few submarkets that do. A few of them in Florida and a few in Texas. But beyond that, pretty much everyone's in good shape. All right. Any questions on that?
No questions.
Man, you guys are a good audience. It's going to be Miller time before you know it here. That's great. All right. So mortgage rates. In 2025, we saw that the mortgage rates dropped by a full point, and the average mortgage payment based on a typical size house dropped by about $350 a month. So that really helped a lot with affordability over the course of the year. Since the end of 25, mortgage rates have dropped a little further yet, even another 1.15%, which is great. So what will happen to mortgage rates this year? Well, you've got a number of economists. MBA is the Mortgage Banker Association. I think they're probably the best informed because they think about mortgages only and nothing else. They think that rates are going to go up slightly this year. The red line is Wells Fargo. They originate a gigantic number of mortgages, so they have a lot of data to think about. They think mortgage rates will be flat. I tend to think that that's probably the most likely forecast. And then the Fannie Mae, which is the guarantor of mortgages, they think that rates are going to go down. I hope they're right, but I think they'll be flat. We'll see what happens. So how should we feel about these mortgage rates today? Are they good or bad? Well, let me give you some context. This is the average mortgage rate by decade over the last 50 years. And you can see the average mortgage rate over the last 50 years has been just a hair under 8%. Currently, we're right at 6%. So historically speaking, the mortgages that we're enjoying right now are historically very attractive. It's only when you compare them to the 2010s, when the average rate was 4%, that these rates look a little bit high. But as people get more and more acclimatized to 6% rates, and the memory of the 3% mortgages sort of fades out of their memory over time, it'll be just one less source of friction for getting deals done. So a great leading indicator for us for the number of homes that is going to get sold is to take a look at the number of people applying for a mortgage, and that's on the left-hand side. That's historically the first step in the chain. You decide with your spouse, I want to buy a house. You talk to a loan officer or banker, bring in your tax forms. They approve you for X dollars a mortgage. You hire a realtor. They help you find the house. That's usually the first thing. So this first chart shows people applying for a mortgage, and you can see that the activity at the beginning of 26 was better than the last couple of years. And that's probably because the rates have dropped by a full point. The next milestone then is you find the house, you put it under contract, you call your lender back up, say, hey, we got a house. I'm sending over a copy of the contract, lock my rate. And on the right-hand side, that's the rate lock. And you can see that all the way on the left-hand side for week 1 and week 2, the number of purchase locks hasn't taken off quite as much yet. That's a lagging indicator. So there's usually like 6 to 8 weeks between applying for a loan and your rate lock. There's another 4 to 6 week lag between the rate lock and the closing. So we should see a little bit more robust closing activity by March of this year. And that would be a good early sign that we're going to sell more homes this year than we did last year, which is kind of what we all think in the economic community. So far, so good. Things are lining up as you'd kind of anticipate. Okay, do these increases rates impact the market? The answer is yes. The number of showings per active listings, so if you're thinking about selling a house, you're not going to get as many showings as you would have had, say, in 2021. No surprise there. Some really good news is that if you ask all these renters, do you think someday you're going to be a first-time buyer? And the answer is yes. About 60% of the renters still want to buy a house. 32% said within 2 years. 27% said in more than 2 years. So all these years where the first-time buyers have been a lot less than expected, they're not gone. They're just sitting on the sideline as pent-up demand. And either as they're able to amass a down payment, or maybe we get a little bit more mortgage rate relief, eventually those people will come into the market and provide buoyancy and push a lot of transactions. So that's a really good sign for the future. So what's next for rentals? Let's talk a little bit about the single family market first. So a lot of you guys on this call might have 3 or 4 single family homes or 3 or 4 condos that you rent out. And you may not be aware that 33% of the rental units in America are 1-unit places. So a lot of you guys are on this call tonight. Another 12% of the housing stock is 2 to 4 units. So there's a lot of us small landlords out there in the marketplace. So in Colorado, at least, there were 9 new laws in 23 and 4 new laws in 24 that were all anti-landlord and pro-tenant, all of which made it a little bit harder to do business. And as a result, I've seen a lot of my clients who've been landlords for quite a while say, you know, I'm done with this. I'm going to sell these off and be a passive investor. If that's you, talk to Nick or I, and we'll help you model out a game plan. We can also do a sensitivity analysis. If you were to sell your rental property and invest passively, what would that mean for wealth creation for you and your family? Something that Nick and I do all the time. We're happy to help you. So the fundamentals of SFR, single family residence, rentals got a little more challenging in 25. You can see the rent growth for homes in 21 was almost 16%, just phenomenal increase in rents. Last year was a 1/4 point. I think this year you'll see a little bit more than that, maybe like 1 or 2%, but not as dramatic as it has been. If you take a look at the vacancy rate, you can see that we're at 6% for single family rentals. That's a little bit higher than typical, but it's not catastrophic by any means. So rents across the entire U.S., there's a fair number of cities that are flat or declining. So in Colorado, 36% of the cities in Colorado had flat or declining rents in 25. If you take a look on the right-hand side, what 10 cities had the biggest declines in annual rent, you can see Aurora made the list, and the rest are in the southeast markets. So Denver, for the most part, was stable, not negative. Let's talk about the multifamily market. So we are structurally short of housing. If you look at the left side, how many homes for rent or for sale has the U.S. built per 1,000 people who live here, and you can see our performance is the lowest of all these different industrialized countries. So a number of economists have tried to estimate how many housing units short are we, and it's in the multiple millions. So since there's more renters than there are available units, overall that should help us to support these relatively high rents. So is it a good time to buy an apartment building? The answer is yes. Prices have declined by 20% on average from the peaks that we saw in 2021. So good time to be a buyer. Interestingly, the last time we had a correction in the market for apartments, 2008, you can see prices dropped about 30%. If you would have bought in 2010, you would have bought at, a relative price of 75, and now it's 200. Your investment would have roughly tripled. Will the next 15 years be as good as that? Probably not as good as that, but they're going to be pretty good. Great time to be a buyer. So absorption just means that we have a unit that had been vacant and we got a tenant to move in and fill that unit. So a good example of that is you've got a kid who's living at home, they graduate from college, they get a job, and they've got enough cash to go get their first apartment. So they are absorbing one unit. So this is a measure of demand. And you can see at the end of 25 that we had several quarters in a row that were record numbers of absorption. So the absorption rates have been just off the chart strong, which has been wonderful. One of the other factors is that the number of people who are single family households, one person households is at a record high. There's 40 million one person households. So it's gone from 7% of households to 29% over the last 65 years. And every time someone decides, I just want to live by myself, that's one more apartment, one more condo that we have to have, so they've got a place to live. So that's a big part of the housing gap, is just all these people deciding to live by themselves. From a supply side, how are we doing? Well, there was a huge number you can see in 2024 of units that were delivered, 600,000. And then 25 was also a strong year, about 470,000 new units. But you can see that the unit count being delivered is going to fall off a cliff. So we've gone from like 600,000 new units getting delivered to 200,000. And it takes about 3 or 4 years for an apartment building to go from initial approval, concept design, breaking ground, construction, lease up. It's a 3 or 4 year process. So we know for at least the next 3 or 4 years, there's not going to be very many units delivered. So it sets us up for this perfect situation where prices of apartment buildings are off by 20%. We've got record amount of demand consuming new units. And on the supply side, we've got a very limited amount of new supply coming on. So what this means is that vacancy rates are set to start coming down, and that we'll start seeing pricing power with rents going up. And cash flow should go up pretty soon. So overall, if you want to invest in apartments, which is primarily what we do at Ironton Capital, it's a really fortunate time to be able to do that.
Got a question, Lon. How many apartment doors have been added to Denver Metro in the last 5 years? Do we have that data?
I don't have that. I would guess the peak would have been around 30,000. So if you said 30,000 in the peak year, maybe 20,000 in the next best year, 70 or 80,000 probably. It's a lot of units. Let's see here.
I think to add to that as well, Denver saw some of the highest supply come into the market amongst most metros, but it's also, competing for one of the top spots in construction start declines as well. So, the construction starts in some of the biggest metros that saw a lot of the highest supply in 2023 to 2025 have completely fallen off a cliff, 60-70% decline in construction starts. So, we're going to be working through all that as we are now, and probably, through a good part of 2026. But to Lon's point, construction starts are down significantly, which is going to bode very well for income growth, therefore property valuations on the multifamily side.
Absolutely, no doubt.
Yeah.
So there's one additional tailwind. Demographics is destiny. So if you take a look at people in the 25 to 34-year-old age cohort that are living at home, it's around 16.5%. And historically, it should be closer to 12. So if all of those young adults moved out and we got to the historical average number of young adults living at home, that would be 940,000 rental units that we'd have to have available for them. So there's an absolutely huge number of people on the sidelines who'd like to buy rent a house. Okay, I think I covered all these concepts for you guys. So I think that's it. I'm going to pause here. Let's take a few minutes to go through any remaining questions that you have.
Yeah, we got 20 minutes, guys, so feel free to fire away if you have any questions. And then to recap what I said in the chat earlier, once the presentation wraps up, you guys will get a recording and the presentation slides as well. If for whatever reason you don't get them, feel free to reach out to us. You can email me, nick@irontoncapital.com, and I'll get you that information. I'll put it in the chat here.
Perfect. Overall, mostly good news for the real estate market, which is pretty exciting. We're past the worst of it. Well, all right. If you guys don't have any questions, we'll let you go for tonight. You can always email me or text me because you'll think of a question as soon as we hang up, I'm sure. I'm always happy to help you out with that later, too.
All right.
Does you have a question in the background there, Nick?
We just had one question. When do you suspect multifamily construction will tick up?
I think it's going to be a little while. I think what will have to happen is within the next 3 or 4 years, you're going to see vacancies decline and rents are going to start going up. And when that happens, the cash flow of these existing units will look attractive. And that will be the starting point for when people say, I want to go build an apartment building. So if that's 3 years from now, it'll be 3 to 4 years before those units hit the market. So we've probably got like a good 6 or 7 year run of very little supply with what should be demographically a very strong time for demand. Great question.
Yeah. All righty.
All right, guys. Well, thanks for your time. Have a great evening.
Thanks, guys. Thanks for being here.